So here's the million-dollar question. With the way the US economy is going, why hasn't the housing market taken a nosedive? Why haven't home prices crashed yet? Well, if you're eagerly waiting for a crash, then you're in the right place. In this video, I'm gonna reveal the top 8 reasons why home prices haven't crashed in 2023 just yet. Now, we've all been hearing the hype year after year about a coming real estate apocalypse. Buyers have been sitting on the sidelines since 2016, hoping for a real estate liquidation, but the unfortunate reality is that many are still renting at insane rates or had to eventually buy at double the price they could have back then. But here's a twist. Despite inflation and rising interest rates, the housing market has managed to stay afloat. And yes, there are still people on the sidelines waiting for a huge price drop, but the real estate market in cities across the United States keeps disappointing them, for now, of course. Quick disclosure, I'm not an economist, but as a real estate agent and investor for 15 years, I keep a pulse on the market relying on reports, data, expert analysis, and of course, current events. It's difficult to predict the future with great certainty, but we can look at the past to get an idea of what's going on and what may or may not happen. So what do the experts and economists have to say about all of this? Let's dive into it, starting with the most obvious reason why the housing market hasn't crashed yet. There's a supply and demand imbalance. It's simple economics 101. Even after 11 interest rate hikes by the Fed, there's hardly anything up for grabs in the housing market. Inventory is ultra low, and it's still very much a seller's market in most parts of the country. Since the dramatic rise in interest rates, certain markets have cooled off a bit with fewer bidding wars, slower appreciation, giving buyers a little more bargaining power. However, there's a serious shortage of available single-family homes in many cities where buyer demand still exceeds supply. Recently, the National Association of Realtors reported that in August 2023, the total number of homes up for sale, including those that are under contract but haven't been sold yet, dropped by 9.2% when compared to last August. And guess what? This isn't a one-time thing. It's actually the 4th month in a row where we've seen a yearly decrease in the total number of listings. So let's look at the stats. The NAR reports a 3.3 month supply of homes for sale. To put that in perspective, back in early 2022, it was a measly 1.7 month supply, and then it grew to 3.2 months of inventory last year, August of 2022. So not a huge change in inventory in the past 12 months. We're talking a 0.1% change, and with so few homes available, it's a clear sign that the whole supply and demand equation isn't going to let a drastic price crash happen at the moment. Even with the amount of home sales down by 15.3%, you could see the median sales prices up by 3.9%. If we look back in time, over a 30-year period prior to 2020, homes in the US gained value at an average rate of about 4.9%, give or take. But things took a pretty interesting turn between 2020 and 2022. In July 2021, home appreciation rates increased by over 19%, which is crazy. In my market here in South Florida, there's still certain properties subject to multiple offer situations in hot areas like Miami and Boca Raton, especially updated single-family homes in open neighborhoods. In fact, in the Palm Beach, Boca area, the median sales price is up 7.1% compared to last year, and inventory has only increased from 2.7 to 2.9. South Florida is still a hot location for retirees and people escaping high tax states from the Northeast. It's definitely slowed down here, but there are people still buying homes. Real estate is extremely hyper-local, and it's true that there are cities that have seen a drop in prices compared to last year, along with an increase in inventory like Boise, Idaho, where in the largest county, median home prices were down by 8%. But again, there's also cities and counties in South Florida that continue to appreciate. The point that I'm trying to make is that real estate is not a one-size-fits-all market, and every location is different. Of course, the data is indicating that appreciation is leveling out in comparison to the crazy overvaluation that we've seen in previous years, but that's not necessarily a bad thing. The decrease in sales we are seeing is primarily due to the increased interest rates and fewer homeowners putting their homes up for sale. We are not in a place where homes aren't selling at all, but the market is definitely cooling off, leading to more days on market and listing price reductions. Inventory is slowly increasing, but there's not enough in the affordable entry-level price range, which is getting hit the hardest. With inflation adding to the lack of affordability, it's super tough for people looking to buy starter homes like our first-time home buyers. Back in the day, starter homes used to be a big deal, making up a whopping 35% of all new homes built back in 1970. But fast forward to now, and they make up less than 10% of the market. Overall, the stockpile of existing homes right now is 50% less than what we saw before the pandemic rolled in. And to make matters worse, new listings have taken a nosedive this year now that interest rates are close to 8%. Homeowners locked into those ultra low interest rates are apprehensive to sell unless they really have to, like probate, divorce, and relocation situations. So that means less pre-existing homes being put on the market for prospective buyers. That brings me to our second reason we haven't seen a crash yet. There's not enough new construction construction to meet the demand. Not enough new construction to meet demand. Currently, new construction makes up about 10% of the housing market. Home builders pulled back after the last crash and they never fully ramped up construction to pre-2007 levels. Fast forward to recent times and there's no way for them to buy land and win regulatory approvals quickly enough to meet demand. So let's look at the current housing stats. For those of you that have never heard that term, housing starts basically means the count of brand new homes that builders have started constructing in a given month. These houses are typically meant for people to live in on a long-term basis, not for short stays. It's all about keeping track of how many new family homes are being built. A lot of people like to reference the crash of 2008, so let's look at the data over a 25-year period for single-family housing stats based on the U.S. Census Bureau. As you can see, building was much more rampant during those times in the past few years. While they are building as much as they can, a repeat of the overbuilding of 15 years ago looks unlikely. In fact, as builders bring more available homes to market and more homeowners decide to sell, supply and demand can come back into balance. But it won't happen overnight, and in certain markets, especially here in South Florida, the new construction single-family homes that are being built are high-end homes in luxury price points, many close to and even surpassing $1 million. Although those homes are beautiful, I would love to see diversification of housing available in a more affordable price point relative to local incomes. However, builders have faced their fair share of challenges, from the pandemic to supply chain hiccups, increasing building costs, and now, just like the home buyers they're catering to, they're feeling the pinch of high borrowing costs, which is equating to those higher prices. One of the major reasons new construction homes were in short supply between 2012 and 2022 is linked to the Millennial generation. Back in 2017, a revealing survey showcased that nearly half of these millennials chose affordable rentals and invested in travel, diverting from home savings. This preference led to a surge in demand for multifamily housing and leasing communities, which builders promptly catered to. I don't know if this is true in your area, but high-end leasing communities seem to be popping up everywhere here in South Florida. So let's talk about the most equity-rich generation that's added fuel to the fire. They've had serious cash from years of home appreciation and are snatching up real estate like no one's business. I'm talking about the baby boomer generation. They used to be the butt of every millennial's blame the boomers jokes. They kind of made it a reality, and all the boomers are laughing all the way to the bank. Number 3, baby boomers are still booming. You know, it's kind of interesting. Baby boomers are actually causing more households to pop up, and it's affecting the housing market. One reason for that is boomers are splitting up due to divorces or sadly because of the loss of a spouse. And in vacation destinations like here in Florida, they continue to buy second homes to escape the cold and to, of course, enjoy the fruits of their labor. Many times, these second homes parallel the qualities of a first-time home buyers, which is another huge issue. Let's talk about an example that perfectly illustrates the dynamics of the housing market. Picture this. Boomers who hail from big cities in places like New York, New Jersey, and California were smart enough to sell their homes at the peak of the market. They walked away with a substantial chunk of equity, giving them a significant advantage in the real estate game over the past few years. As these savvy boomers decided to downsize and make the move to more affordable locations like Texas, the Carolinas, and of course Florida, they brought along a wad of cash. Armed with such financial firepower, they could easily offer more than the appraised value of a property. And you know what? They often outmaneuvered other buyers who were relying on financing, especially the local buyers. What's even more interesting is that a considerable portion of those boomers remained unaffected by the spike in interest rates. This put them in an amazing position of power throughout 2022 and parts of 2023. They had the upper hand in bidding wars and could effortlessly negotiate with cash in hand. Some of them, incredibly enough, sold their homes at the market's peak, cashed out, and parked their money in secure money market accounts instead of buying another property right away. They decided to rent, anticipating a cooling off of the market in 2023. Now that we're seeing homes sitting longer on the market, these boomers have even more negotiating power in the months to come. It's truly a fascinating strategy that has paid off for them, and who knows, they might just have the last laugh after all. You know, all of this, it's a bit of a catch-22. While the boomers will eventually need fewer homes as they get older, that's not happening anytime soon, according to experts. The youngest boomers are around 59 years old, so there's still a bunch of them out there in the workforce. They'll be retiring over the next several years, and that's only going to further add to the demand for housing, especially more higher-end active adult communities with amenities to support their lifestyle. Number 4, millennials. Well, folks, millennials have pulled off quite the feat. They finally became the majority homeowners, and in 2022, their homeownership rates hit 51.5% according to the census data. And get this, this, even in those pricey metro areas like New York and Los Angeles, millennials were buying homes. But let's take a step back and think about this for a second. Have we all been underestimating the life prospects of the millennial generation, including the critics and millennials themselves? Millennials might not have completely outrun generations that have simply been earning longer like baby boomers and Gen Xers, but they've made some serious gains in the homeownership race. Why? Because they're hitting the sweet spots in their lives for buying homes. Once millennials begin growing their families on top of being deeply impacted by the pandemic in 2020, it was time to ditch their small, pricey downtown rentals and move to the suburbs. Now, let's rewind a bit in case everyone forgot their history. Many millennials fresh out of college during a down economy like myself had to face the harsh reality of a tough job market and not so fat paychecks thanks to the big global recession that kicked off in 2007. To make matters worse, many were burdened by student loans, income inequality was doing its thing, and housing prices were playing a game of catch me if you can by soaring faster than wages after 2010. Unfortunately, their expensive bachelor degrees didn't help them as anticipated, and it took second jobs as bartenders, phone sales reps, and self-taught coding or tech skills to get ahead. Many even continued living with mom and dad into their late 20s, early 30s as an effort to save money for down payments on a home or rental. So let's break it down by the numbers. By the time millennials hit the big 3-0, only 42% of millennials finally had a place to call their own. In comparison, 48% of Gen Xers and 51% of baby boomers that were already homeowners at that age. And guess what? This homeownership gap kind of lingers into their early 40s, with the oldest millennials still trailing behind previous generations when they were the same age. We also have to take into consideration the rise of available information, internet gurus telling them to ditch buying a primary residence and rent instead, political propaganda, Bitcoin, and other types of publicized investments. They've definitely had their own set of complex challenges in the housing game. Another biggie is building up home equity, which is like the superpower of home ownership. But here's a twist. Some millennials who bought homes during the pandemic had to dip into their home equity for a bit of extra cash because of the current inflation crisis. Millennial home equity took a nosedive, dropping by a whopping 18.2% year over year. That's a bigger decline than any other generation, according to the folks over at Redfin. And what's causing this roller coaster ride? Well, experts think it's because millennials are tapping into their home equity lines of credit in the form of a HELOC to pay off debts like credit card bills and previous student loans that are still haunting them. As I said earlier, we have seen a dose of competition between the millennials buying their first homes and boomers downsizing, especially right after the pandemic. Both generations, millennial and baby boomers, bidding on the same homes, which definitely affects inventory. Again, it's been rampant in states here like Florida, where those equity-rich boomers escaping the Northeast are outbidding local millennials and sending them to look elsewhere in the Southeast like Carolinas and Tennessee. The good news is that the wave of Northerners that flocked here from 2020 to 2023 significantly slowed down. The bad news, of course, is the inflation and interest rates nearing 8%. Not to mention that we are on the brink of a possible World War III with everything going on overseas, which would definitely crash the economy if the forces that be don't get everything in check. There's, of course, another ingredient that's adding to the mix, making it difficult for millennials to buy, which is investors. Number 5, investors. Institutional, foreign, mom and pop, all kinds of investors have been on the scene in recent years thanks to technology and capitalization on increasing rental rates. Unfortunately, when Airbnb blew up, everyone and their mom wanted to seize the opportunity with good reason, massive returns. They started snagging up properties left and right in downtown areas, single-family homes with no restrictions, and then, like magic, turn them into short-term rental homes for vacationers, travel nurses, remote workers, and those needing a place to stay in between selling their home and buying a new one. When mortgage rates decided to creep up along with home prices, well, many eager would-be buyers had to keep renting, which in turn cranked up the demand for rental properties even more, including those short-term ones. As we talked about earlier, there were plenty of homeowners who wanted to make a move but didn't want to say goodbye to their sweet 3% mortgage rate. So what did some of them do? They thought, hey, why not rent out the place that I'm leaving? It was the perfect way to cover the cost while holding onto a home and moving into another one. The rental market exploded, and yet again, local buyers and long-term renters were impacted not only by increase in prices, but no availability of housing. Due to these concerns, along with concerns about crime, cities across the nation have been implementing more restrictions on short-term rentals like Airbnb, and some places like Manhattan and South Beach have completely outlawed them. It will be interesting to see how this plays out in the next several months. We are already seeing Airbnb owners sell off their inventory in areas seeing a decline in profits. Will this be enough to shake up the market and lead to a crash and huge price decreases? overlooked. Another reason why the market hasn't crashed yet is the pandemic's effect on work environments and explosion of work from home jobs. Number 6, shifts in the job market, work from home. There's this recent study that's saying remote work is the big reason behind the crazy hike in home prices and rents. In a report called Remote Work and Housing Demand, published by the Federal Reserve Bank of San Francisco, they found that housing prices shot up by a whopping 24% between November 2019 and November 2021. And guess what? More than 60% of that surge is thanks to remote work. It's not just homes that got pricier, but rents too. As of August 2022, about 30% of folks in the US were still working remotely, and that's a 16% point increase from November 2019 to November 2021. Here's the deal. When the pandemic hit, people started looking for homes in places that were easier on their wallets and had better amenities. So they left those pricey areas for more affordable cities, and that's what drove up the cost of homes. Plus, everyone suddenly wanted homes in warmer places with more room to stretch out, and that also had a hand in pushing up those home prices. According to Forbes, in 2023, around 12.7% of full-time employees are doing their job from home, and about 28.2% are rocking a hybrid work setup. It's pretty clear that remote work has become a normal thing really fast. So yeah, almost 13% are full-time home office pros, and a big chunk, 28.2%, are balancing between office and home. Remote work is here to stay as long as millennials dominate the workforce in 2023 and beyond. The expectations of working millennials will shape the future of remote work opportunities, and unlike previous generations like baby boomers who find remote work nice but not essential, younger generations are driving the demand for flexible work arrangements. Now, while companies won't face pressure from older generations to offer remote work, the trend towards remote work is likely to continue growing due to the preferences of newer generations. Number 7, strict lending standards. Let's dive into the wide world of lending standards. Back in 2007, the mortgage scene was a bit like the Wild West, where you could get a loan without even proving your income. They call them liar loans, where honesty was optional. Lenders were handing out mortgages like they were handing out candy on Halloween, no matter your credit history or your down payment size. It was a free-for-all built on greed. I won't harp too much on this because I think YouTube gurus have already beat you over the head with this info, but it's definitely more challenging to get a loan today than it was then. Lenders have become the guardians of credit scores. In fact, the median credit score for mortgage borrowers in the second quarter of 2023 was a jaw-dropping 769, according to the Federal Reserve Bank of New York. We've come a long way from the days of those zero down payments, ninja loans, which is no income, assets, or job verification, interest only, and predatory loans. Nowadays, most homebuyers, especially since 2007, are opting for more stable options like a 15-year or a 30-year fixed-rate mortgages. The beauty of these fixed-rate mortgages is so that there are no nasty surprises when interest rates rise. If you've got a fixed-rate mortgage, you know exactly what you're in for. Plus, getting qualified for a mortgage nowadays means you've been through some rigorous vetting. They're not just handing out loans to anyone who asks. The main issue at the moment preventing buyers from entering the market is interest rates and lack of affordability. However, lenders are getting creative with programs like 3-2-1 buy downs, which allow buyers to secure a lower interest rate for the first few years. Basically, in the first year, they lower your interest rate by 3%. Then in the second year, they further reduce it by 2%. Finally, in the third year, they bring it down by an additional 1%, which is a good way for buyers to save some money in a market with ultra high rates. FHA also recently changed the criteria for purchasing a multifamily home, like a duplex or a triplex or a quadplex, with as little as 5% down if one of the units is the buyer's primary residence. I always tell buyers not to completely shoot down the idea of buying solely out of fear. It's really important to be educated on all the programs available and understand what's feasible in your situation. Now let's talk about foreclosures, a once feared entity that haunted the housing market. Number 8, low foreclosures. Back in the aftermath of the housing crash in 2008, foreclosures were rampant and they were like a wrecking ball to home prices. But hold the drama, that hasn't been the case this last year. Now we all know foreclosures aren't a good sign. They were a big red flag during the Great Recession back in 2008 and 2009, when foreclosures were up by 80%. This recent data shows a 7% increase from April 2022 and a 14% increase year over year. But what's causing all of this, and what's next? Well, COVID-19 was a major player. The lifting of COVID-19 related moratoriums has led to more distressed properties hitting the market. People who deferred mortgage payments during the pandemic are now dealing with homes whose prices have flattened or even dropped, leaving them underwater. Everyone's wondering if the rise in foreclosures could mean more distressed properties on the market, potentially stabilizing the market, or even transitioning to a buyer's market. There's plenty of people hoping for prices to drop, especially investors looking to snag properties at a discount and work on renovations or turn them into rentals. But what about renters? Rising insurance costs and taxes might push people to rent instead of buying. This could be good news for homeowners looking to make extra cash through rental properties. So should you worry? Well, experts say it's not time to hit the panic button just yet. Foreclosure rates are on the rise, but it's not as dire as it may seem. We're moving towards a more normal level of foreclosure filings, and it's still a long way from the crisis levels of 2008. So keep an eye out, but don't stress out too much unless you see a whopping 50% spike in foreclosures. Then it might be time to worry. Today, most homeowners have built up a cozy cushion of equity in their homes. Lenders weren't in a hurry to file default notices during the height of the pandemic, which pushed foreclosures to record lows in 2020. In a nutshell, the lending standards and foreclosure scene have done a complete 180 from the Wild West days of 2007, but it's still something to keep an eye on in the months to come. And there you have it. But before we wrap things up, let's revisit the burning question on everyone's mind. Will the market crash in 2023? Now, I don't have a magical crystal ball, but it seems highly unlikely that we'll witness a significant market crash as we approach the end of this year unless war breaks loose. While home prices did experience a slight decrease after years of consistent growth and the once scorching hot market may have cooled down a bit based on the factors I discussed, it's unlikely to take a sharp nosedive. Experts suggest that prices are more likely to plateau and remain relatively stable for the rest of 2023 instead of experience a steep fall. However, as the old saying goes, what goes up must come down, and it's only a matter of time. Perhaps 2024 could be the year we see some adjustments if inflation and interest rates fail to stabilize. And of course, unforeseen events like war could potentially shake things up. But enough about my thoughts. I want to hear from you. Do you agree with the experts' predictions? What's the current real estate scene like where you live? Have you stumbled upon any properties with jaw-dropping discounts? Drop a comment below and let's keep the conversation going. I hope you found today's video insightful and thought-provoking. If you enjoyed it, please show your support by giving it a thumbs up. And remember, if you have any real estate related questions or need assistance, don't hesitate to reach out. If you're considering a move in or around South Florida, my name is Jonathan and my team would be thrilled to help you out. You can find all of my contact information in the description below. Thank you for joining me today. I'll catch you in the next video.